we could be right in the beginning of the flush down of John Exter's inverted pyramid. So what is John Exter's inverted pyramid, and who is John Exter? Tuesday, July 20th, 2021, Monaco 64, home of alternative economics and contrarian views. The markets look very interesting. Yesterday, we had some pretty big drops intraday. Yes, and the markets dropped quite a bit. At the end of the day, they were down over 1%. Not huge. They did recover a little bit. My concern here is that investors are losing faith and confidence in the whole system. And I think if we look at the reverse repo situation, where the banks are keeping almost $1 trillion with the Fed overnight, rolling it over every day, and not lending it out to the real economy, is not a good sign. We've seen recently that Wells Fargo has announced they're going to stop issuing their customers lines of credits. That's not a good sign either. It shows that the banks have a problem. I think they realize that the economy is not as healthy as the central bankers and the politicians try to paint it. I think this crisis of the last 12 to 16 months is pretty serious. It's not just about the health crisis. I think there was a credit crisis already, a faith and confidence crisis already that started back in 2019, around September time, with the repo market. What is a repo market? I mean, I worked in the financial markets in the city of London for over 20 years, and very few people even in the city know what it is. Well, to explain it to the men or women out there on the street, it's basically a pawn shop for Wall Street. So what you have is banks, primary dealers. Primary dealers are also the banks. They deal in government securities for the U.S. Treasury. When the U.S. Treasury issues debt, the primary dealers are involved in the auction process, and they're involved in the secondary market. And it's a pawn shop as well, where hedge funds and other financial institutions like insurance companies, mutual funds, go to access cash. Just like in a pawn shop. So they'll come with some of their treasuries or mortgage-backed securities, and they'll ask the pawn shop owner, which is basically the primary dealers and the big banks. They'll ask him, I want to borrow $1 billion overnight, and I'll leave some treasuries with you. Can you do that for me? And back in September, that mechanism broke down. The banks or primary dealers wouldn't lend even overnight, even with the counterparties pledging government securities and mortgage-backed securities. So the repo rate went up to almost 10%. It was over 7% above the Fed funds overnight rate. And that's because financial institutions on Wall Street, City of London, all around the world, were losing faith and confidence in each other. They didn't want to deal with each other. There was a big problem. Yes, the BIS came out later and said it was a few hedge funds. And why is there such a huge problem when markets start getting a little volatile? Well, it's because the financial markets have something that most people don't realize, and that's a huge amount of leverage and margin driving it. It's all the greed. It's what caused the major financial crises in the last 120 years. It's always margin and debt. And especially now with derivatives, financial derivatives, agricultural derivatives, commodity derivatives have been around for a long time, but the kind of derivatives we have today on interest rates, on stock market indices, on currencies. All these things are relatively new. They just haven't been around that long. They've been around probably since mid to late 80s, and they really started mushrooming after 1999 when the Glass-Steagall Act was repealed by the Clinton administration. And now you've got the big banks, commercial banks, involved in derivatives, and that's why it's mushroomed so much. And I have a feeling there's a problem out there, and the Fed is now cornered, in my opinion, because they could come out and say, oh, we're going to increase QE, we're going to buy stocks and everything, but they could basically do that, but that would even be worse for the dollar, I think. And that's why yesterday we actually saw gold. Yes, it didn't go up, but it didn't go down that much. Gold do very well. Yes, treasuries went up because people still have the idea that U.S. treasuries are safe haven assets, that they're guaranteed, that, and to some extent, people are right, because as Alan Greenspan once said, the Treasury, the government can just print the money and pay the debt. And that's true, but what that will do as well, it will decrease the purchasing power of the United States currency, because that's what happens when the Treasury issues more and more debt. The other side of the debt will be currency. So, yeah, I'm wondering here what the Fed is going to do. The banks, for example, the primary dealers especially, they're the ones who participate in the government auctions of debt. So unless the government and Congress increase spending even more, increase the debt even more, you'd probably see the Federal Reserve having to start monetizing the stock market. And that would be a really bad signal, in my opinion. Or they could also continue to buy treasuries, that we could see more fiscal stimulus. But as we've seen since the end of March, because of regulatory reasons, the big banks, the primary dealers, they're up to here in terms of their statutory leverage ratios. Their capital buffers they've gone out the window, and that's one of the reasons they're having to park all this cash as well at the Fed. The Fed has cornered itself, and it might even have to start buying directly from the U.S. Treasury, the debt. And that's another red flag for foreign investors, for sovereign countries who are already leaving the dollar. We even saw Brazil in June increase its gold reserves by 62%. We're seeing China and Russia do the same. Russia announced as well that their sovereign wealth fund will not have any dollar instruments. So where I think we are at is a very dangerous junction. We could be right in the beginning of the flush down of John Exter's inverted pyramid. So what is John Exter's inverted pyramid, and who is John Exter? Well, John Exter was a central banker. He worked for the Federal Reserve Bank of New York. He worked for institutions like the World Bank. He helped found the Central Bank of Sri Lanka, or as it was called at the time, Ceylon. He was heavily involved as well in the Philippines, in creating the Philippine Central Bank. So he was a very knowledgeable guy. He was a gold bug as well in the 60s. He was buying a lot of gold. He did very well in the 70s. And he was a Wall Street guy. He was a Federal Reserve guy, and he even advised Paul Volcker when Nixon closed the gold window. Paul Volcker was Assistant Treasury Secretary for International Affairs. And when they were meeting at Camp David on the fateful weekend that Nixon closed the gold window, August 15th was a Sunday, 1971, Paul Volcker consulted with John Exter and asked him, what can we do to stop the flow of gold out of the country? John Exter said, well, you can raise interest rates, which Nixon wasn't willing to do. Politicians hate raising interest rates. He said, you can revalue the price of gold or devalue the dollar from $35 to wherever you think is appropriate, or you can close the gold window, you can default, because that's basically what it was, a default. And John Exter knew exactly what that would lead to, and he wrote a really great piece for the American Institute for Economic Research back in 1972, just after the gold window was closed, and I recommend you read it. I've spoken about it many times. And he says currencies today are IOU nothings, basically backed by nothing, money backed by nothing. And this is what he says at the end, and I quote, in the days to come, international monetary reformers will have to consider whether these new kinds of money will produce a stable monetary world in the world's marketplaces. Will they hold their value against goods and services in general? More particularly, will those issued by different central banks hold their value against one another? Most particularly, and here's the kicker, and here's why I tell people that you need some gold. You need some gold, or as much as you can get. Silver as well. Silver is a different animal because it's monetary and industrial. But I think it will do well as well once the dust settles. So I repeat here, most particularly, will any of them hold their value against store of value money like gold? So let's just quickly look through what John Exter's pyramid is. Well, his hypothesis, his theory is that eventually this IOU nothing system, which is basically what fiat currency is, would implode because of all the debt that's been created, because you can only keep going by creating more debt, because if you stop, the system just grinds to a halt. And that's why whenever there is some kind of market correction like we've seen in the last 10 years, the Fed comes in and becomes even more accommodative, or starts printing more money, or cuts rates, or goes negative, even some other central banks. But we need to be prepared for this scenario as well. And it would be the opposite, I guess, of hyperinflation, but it would have the same effect. It would destroy all the fiat currencies. You can see that at the top of the pyramid, the inverted pyramid, are the riskiest assets. When John Exter devised or came up with this inverted pyramid idea, he didn't have derivatives up there because they were not as popular or prevalent as they are today. So someone has added derivatives to that. That's the riskiest and most leveraged kind of asset class. It's not even an asset, because derivatives, of course, are bets. They're bets on underlying assets. And they're so opaque and not transparent that people don't even know the notional amount of derivatives out there. But it's probably more than $1 quadrillion. What's a quadrillion? Well, it's 1,000 trillion. People don't even know. And that's the whole problem with this system, that it's so leveraged. And then you've got non-monetary commodities, not gold and silver. So private businesses, real estate, and below that you've got corporate and municipal bonds, securitized debt, and listed stocks. And then you've got government bonds and treasury bills, and then paper money, which is the Federal Reserve notes. And then right at the bottom, you've got gold. And I would add silver to that as well. And what happens in a collapse of the whole system, the liquidity is destroyed, and it flows right down to the bottom of the pyramid. And that's why we might see actually government bonds rising, everything imploding around, and actually gold and silver holding. I know silver didn't do well yesterday, and it might still go further down, but yeah, this is just, I'm not saying this is going to happen, but yesterday felt a little bit like that, because the only thing that did relatively well were government bonds and gold. Gold held quite well. Yeah, it did come off intraday, but it held very firmly considering what we saw. So yes, I have been talking about hyperinflation, and that could happen as well, and would have the same impact because it would destroy the currency. And in this case here, I would say that it would probably destroy government bonds and paper money as well, even though the liquidity would flow to those places. At the end, though, the only thing standing would be gold. And why is that? Well, because the economy would be in tatters if that were to happen. And the government wouldn't have any tax receipts to service their debt or government bonds. They would default. So, I mean, this has never happened before, so I could be wrong, but it's something to think about and something to keep in the back of your mind. So with that, let's quickly look at where the markets are this morning. It's just gone past 8 a.m. London. Someone asked me a question yesterday in the video because I said it was very hot, and I wanted to do the video early before it got too hot. And the question was, why don't you have air conditioning? Well, here in England, you can get summers that the temperature never gets that far above 22 centigrade, which is, I would say, 75 or 80 degrees Fahrenheit. Yes, once in a while we get a week or two of very hot temperatures in the summer, but this year, for example, in May, it was still really cold. So the most important thing to have in the UK is not air conditioning, but heating. It's not really worth having air conditioning in the house. It's not economical. Yes, offices have air conditioning and businesses have air conditioning, but usually not residential houses. Anyway, we've got spot gold up about $4 at 18.16. So gold's still holding fairly well. Low has been 18.10, high 18.1950. Silver is down 2 cents at 25.15. Range has been 25.06 to 25.29. The stock market is rebounding this morning. The future, the Dow future is up 0.5% or 160 points. The NASDAQ 100 futures up 71. S&P is up 19 points. So yeah, rebounding a little bit here. I still think there's a lot of trouble out there. The drop in Treasury yields yesterday was quite significant. I think there's a lot of fear out there about something. Yes, it might be maybe new lockdowns, but that's just a headline. That's them trying to cover really the fact that all is not well in the financial and monetary system. This system of fiat currency and endless debt is not sustainable. And we're getting close to 50 years, right? Next month. So to the fiat currencies to see how they're doing against each other. Sterling has not been doing well. It dropped quite a bit yesterday. It was down over almost 1%, I would say. And it's breaking key support here. Right now, it's down another 0.25% at 136.38. Euro is holding up a little better than sterling. It's down 0.1% at 117.83. Dollar's up slightly versus the Japanese yen, 109.62. And the dollar's unchanged versus the yuan at 648.84. Aussie dollar is at 73.28, down 0.2%. And the dollar is up 0.1% versus the Canadian dollar at 127.65. Yes, the non-monetary commodities got hammered yesterday. I mean, when I did my video yesterday morning, crude oil was almost around 71, I think. Right now we're at 67 and it's up 1% or 81 cents. High-grade copper as well took a beating yesterday. Right now it's up 1% at 423.89. Just to finish off, just look at the Treasury market. The 10-year yield is up 2.6 basis points at 1.21%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. I wish you all a great day. Take care. Bye.